beneath the veneer, I think there's two things to focus on. On the inflation side, certainly from a bond market perspective, the wage number is going to be key. We had a 0.4% in average hourly earnings in August. The market's looking at plus 0.3, and I think if we get another plus 0.4, that's going to provide more jitters. If you go back to the beginning of the year when we had that first round of market anxiety, it was around the risk of higher wage inflation. Those were risks back then. I think it's actually starting to show up in the actual data. That's one of the risks today from a market standpoint. Of course, it's good news for Main Street to see higher wages. The other one is factory payrolls. I think one of the sore spots in the ADP number, which looks so great on the surface, once again, manufacturing employment almost evaporated in that report. Its lowest increase since July of last year, and that would provide the markets with a bit of nervousness over the impact of the tariff war starting, and the stronger dollar, by the way, starting to impact on manufacturing employment, which for the past year had been a bright spot. So those are the two potential worry spots I'd be looking for today.
David, you have an economist hat and a strategist hat as well. Has it been worrisome for you at all on either front, the velocity at which yields have risen over the past few days?
It's been really breathtaking, especially when you consider that the net speculative short position on the 10-year note in the futures and option pits has never been as high as it is today. I had actually thought that the bond sellers had already exhausted themselves. I guess they haven't. So I think you're 100% right, Dominic. It's not just the move, but really the speed of the move. I think this is almost like a mini taper tantrum that we have in our hands, because a lot of this I don't really think is premised just on the economic data. A lot of the bump we're seeing right now is really due to a lot of transitory factors, which I'll be talking about in my daily today. But I think that people had the wrong idea on Jay Powell, that he was going to be relatively soft. I think the comments that he made in Washington yesterday afternoon, or this was 2 days ago, reflecting the fact that he thinks that we're a long way from neutral, and neutral is roughly 3% of the funds rate, and that the Fed's got to go beyond neutral. Took a lot of people by surprise, because the markets were not in line with the Fed in terms of how far they'd have to go between now and the end of 2019. So I think we are seeing a level of expectations start to change as it relates to where the Fed's going to be.